Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? We're financial advisors here. Hope you'll check us out at jazzwealth.com. I don't need to do the promotion because I think the shirt will do the trick today. So we're going to get into some good stuff here. Trying to maybe go a little different route with some of these FinTips videos lately to make them more current and on sort of topic with what's happening in the world, because there's a lot going on. We have so much data we're trying to keep up with right now. And let me share some of that with you today. What we're looking for in this study and the data and the stocks that I'm going to share with you today is dependable dividends. That's the key word. We're looking for dependable dividends. We are not suggesting the stocks here that we think will have the best price improvement. We are not suggesting things like that. We're looking for the stocks with the most dependable dividend, not the highest dividend, not the best performing stock, not the most volatile stock, least volatile stock. You get what I'm saying? We're looking for dependability, because what's happening out there is, investors, retirees currently are relying on income from stocks. See, they're forced into the stock market because their bonds aren't paying anything. And so they go to the stock market and they're looking for yield. They don't need growth, they need yield. And so if you're a retiree, it's really, really important that you be very choosy about where you're looking for yield right now, because the second you buy something like a Carnival Cruise, an ExxonMobil, whatever, Boeing, all of a sudden, poof, there goes your dividend. They're not paying anymore. In fact, 134 companies in the first quarter of 2020 cut their dividends. So we thought, that sounds like a lot. Let's go and see if that's normal. Looking back last year, 108 companies cut their dividends, like erased them, not cut them, just flat out erased them in the first quarter of 2019. The problem with it is it's the dollar amount that was cut or eliminated in these dividends. It's actually this quarter, or first quarter of 2020, it's $18 billion that was cut. Was not the case in 2019. It was just companies that got rid of their dividends there. So it turns out to be kind of a bigger deal. When you balance out the number of the net dollar amount of increases to decreases in dividends overall, you've got a drop of $5.5 billion. If you take a look at that, you can go all the way back as far as you can until you find a decrease of that amount. You end up in 2009, right at the end of the financial crisis, a little bit rough, right? So no doubt things are rough out there. What we wanted to do was look back and see fundamentally strong companies that could pay their debts back quickly if they even have any debt. So there's going to be some tech names in here. We look for, just for fun since we have it, we look for higher companies that have higher credit ratings. So we searched by companies that had at least a AAA S&P credit rating all the way down to an A. Anything less than that we didn't accept. And then we just kind of started putting things together to see which dividend, which one of these companies as a group would pay the biggest dividend. And then I'm going to get into some of the geeky stuff as well. So let's take a look at the list here real quick. We'll put it up on the screen. The first thing we've got is our list of dependable dividend stocks. Like I said, with the screens and everything that we put through there. Now, you're going to notice there's a couple large cap names in the mix there. In fact, Microsoft being the first on the screen as far as the first ticker there. Stock has done well this year so far. Actually, year to date, it's the only one on this list that is positive, meaning it's actually got a gain year to date. I should be able to pull that up for you. Yeah, if you take a look here, the purple line is going to be Microsoft. And you can see over here off to the left, that zero mark. Every other stock is below that, so naturally there's a lot of stocks like that, but Microsoft happens to be the only one that has kind of beat zero. It's doing better than zero. So if I go back to the list there, one issue that I have with this one, although it's a dependable one, it's got a AAA credit rating, plenty of cash to pay the dividends, no debt, right? So not a big deal there. If things get rough, they can afford to operate. But what I didn't like about it is the stock price relative to the yield. See, if you look on the screen, you've got a stock price of $178.60 as of the weekend when I recorded this. The dividend yield's 1.15%. I don't really like that. I don't like the price versus the yield. That could be a sticking point for some people that don't have a lot of money, don't have options to use the fractional shares and such. So that one I've marked in red there just to put that there. Next, you got automatic data processing there. They've got a higher dividend yield. You can see 2.6% there. And then Cisco marks out the highest dividend yield at 3.37% there. A lot of people think, hey, working from home, these companies should do well there. Wall Street thinks the same as well, and got a high dividend yield there for Cisco. If you look a little bit further, you've got Merck on the list there. Second highest dividend yield, by the way. fair price relative to the yield. Obviously a good credit rating, plenty of cash on the books there, and they've done well here over the last couple of weeks. They've got over the last 4 weeks, actually, they have a gain of about 25%. They're still not positive on the year, though, but I think we give them a little slack, down about 8.24% as of this recording in terms of stock there. So you would say year to date, you're still getting at least a little bit of a discount there, and a dependable yield if it's something that you're looking to there. Market cap now over $200 billion for Merck. We got some healthcare stocks in there. Medtronics and Anthem, you might notice on the list there as well. You got 1.54%, no, I'm sorry, you got 2.26% yield, and then you've got 2.15%. If you're looking there. So, I mean, something to consider if you're taking a look at those. Consumer names, got a nice little mix in there. You got Nike, you got Target on the screen, you can see there as well. You know, Target's done well lately. Last week they actually got a upgrade at BMO, so they were rather positive on it. Do I have the quote? Let me share the quote here with you. So BMO's quote actually was, and this is kind of interesting, it's a little bit geeky, I'll break it down. Market share trends in the discretionary categories, the company Target, their market share trends in discretionary categories are poised to accelerate in a post-COVID-19 retail landscape as competitor closures accelerate and or competitors emerge from the crisis in a higher leverage situation. Basically what they were saying there, if that's analyst talk for saying, you know what's going to happen with Target, their discretionary products that they have, which people really aren't buying a whole lot of right now, the other companies that sell those types of things, they're probably going to go bankrupt, or they're not going to be as visible, have as many stores, not do as much advertising, and that bodes well for Target because they already have that stuff there. They've got the advertising budget. They're obviously going to make it through this, and so that's a good one there. I thought that was interesting. And so Target's on the list there, looking good there as well. You got manufacturing company there, Illinois Tool Works. This one I marked in red there for you if you're taking a look or you want to do your own research there. 2.79% yield overall. Obviously a great credit rating off to the side if you care about that as well. But the stock price is currently above the average analyst estimates there. You're going to see a lot of this week from me where maybe some of these ideas, we're going to share a couple studies this week as well with other stocks, how to build different portfolios of stocks for different time periods, but a lot of these stocks are currently trading a little bit rich relative to what analysts think. Well, Illinois Tool Works is one of those there. Average estimate is currently at 146, so we're trading above that. Wells Fargo does offer a standout. They think it's going to go to 180, but I maintain that if the markets do pull back a little bit, you get a discount on some of these names here. So it might be a matter of just being a little bit choosy about the timing you start the investments or as you scale into some of these if you're looking for income as well. That basically wraps up what I was trying to share with you there. Here's the performance chart one more time of these stocks here. You can see the worst performer on the mix. Actually, that's not even real. That needs to go away. That wasn't supposed to be in there. There you go. So you can see the worst performer on the mix there and how they're performing year to date. If you go over the last month here, you just want to see that spread between who's doing well and who's starting to kind of like pick up there. Medtronics peaking up a little bit. Good gain over the last month. Healthcare stocks, you know, have done really well over the last month. But the bottom line is we're just trying to share some idea of the performance. Oh, let me take a look at one more thing. I told you I would do this for you. We go back to the slide there, bottom in the gray area there, portfolio yield. Can you see my cursor actually? I don't think the cursor shows up for whatever reason. But if you go down to the bottom there, the portfolio yield, this is basically if you were to build a portfolio of all these stocks and you didn't pick a stock, you just said, okay, if these are dependable, I'll build my own portfolio and I'll have these. Your dividend yield in the portfolio would be 2.29%, meaning if you equal weighted them and bought them all together, you would have a package that was yielding 2.29% as a whole. Volatility is going to be a little bit much, or a little bit more compared to the S&P. So I put the volatility of the portfolio there for you, how much wiggling back and forth you could expect, relative to how much wiggling back and forth the S&P is doing. And I think you guys have watched long enough. I could probably start going a little bit geekier with you instead of just saying wiggling. I feel bad. I'm trying to simplify it, but in the same respects, I think I lose a little credibility because they think like he doesn't know what he's talking about. Anyways, you get the idea here. You have a little bit more volatility in a portfolio made up of these stocks of dependable dividend-paying stocks versus the S&P. However, your yield is slightly better there, and you have, well, technically less risk and less exposure in a few different ways. But yeah, just wanted to point that out. I hope that was helpful. I hope it was something interesting or different to take a look at. By no means are they stock recommendations, and I mentioned that already. We're not looking for the highest yield or anything like that. We're just looking for the most dependable companies. If you're a yield-based investor, which a lot of people are really stuck right now and just having a hard time doing that and keeping their income levels up in retirement. So if that's one of you, or you happen to have a family member, maybe you share this video with them. I do appreciate it. Maybe you'll hit the subscribe button as well if I did help you. If not, I'll try again on Wednesday. We do these videos every other day. So yeah, I hope you'll come back and enjoy the rest of your day.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.